The real value of AFX, is the data, because the data can sit alongside SOFR rather than taking what SOFR has said is this arbitrary credit spread for 1, 3, 6, and 9 months. We show empirically what that is. It's not 14 basis points in threes. Today it was 21 basis points. So that's telling people that something's happening, right? We're now moving for a reason. And I have the data that shows that that's in fact happening. We're not trying to replace SOFR by any means. We're trying to simply be an alternative or cooperate alongside of SOFR where we can, where we reflect the real credit spread so that the community and regional banks have an opportunity to be treated fairly.
What has been happening at AFX since the election?
There has definitely been a groundswell or building groundswell of interest around a potential for an alternative rate, credit sensitive rate to at least coexist or to cooperate with SOFR in some shape, form, or fashion. You know, you see that in the prior regime and under SEC Chairman Gensler, you had, you know, this belief that you had to create this impervious mountain of impenetrable data that would prevent any single bank from manipulating a rate. So let's just use this vastness of the repo market and let's take that collateralized government collateral as the benchmark. And then let's figure out how we could shove that into a LIBOR rate, which was really a forward-looking credit rate. Yes, based upon quotes, not actual transactions. And because of now announced that Chairman Gensler is departing the SEC, and we have just been informed that Atkins will be coming in, who is, I think, most of the information around him has been his pro-crypto stance. But we suspect that we're not going to have this political overreach from the SEC under the new administration, but we're going to see a more reasonable approach to markets, certainly around liquidity, certainly around the ability for community, regional, smaller banks to be able to price risk. And, you know, for our 250 or so clients, they've become pretty reliant upon not only being able to trade on our platform, but being able to use our data to price loans to their clients. And under the prior regime, they've been limited in how they could hedge those loans via either swaps or futures. So we're hoping that this will open up an opportunity for both an OTC swap market, maybe even a Fed funds futures market, and then a return to us offering a 3-month Ameribor credit sensitive rate future again.
What new products are you looking to offer?
We're actively pursuing product designs that we have somewhat whiteboarded for RFQs in CDs and RFQs in commercial paper that go out the term, out to 3 months, 6 months, 9 months, 1 year or longer, all allowing us to then take that data into AFX and then use that for our forward-based calculations that will further underpin and support the Ameribor index. So think of the world of 2A7 money funds and other real buy sides. Obviously, the amount of assets now sitting in short-term money markets is at an all-time high. It'd be great to have something that is fully electronic, fully locked in, but then at the same time supports an index that so many of our bank members and partners are using to price assets. And it's not a small amount. And as we've done the research, you could see that the amount of Ameribor linked loans out there is now in the tens of billions of notional. Compared to SOFR, I realize it's a rounding error and it rounds to zero. But our amounts have the opportunity to really grow substantially, especially as we could bring more of the short-term market into us by providing RFQ to a certain group of, whether it be buy-side money funds from issuers or vice versa, where a money fund wants to see if XYZ issuer has an interest to issue CDs or issue commercial paper. All of this would be available at some point on the AFX platform.
Any plan for tokenization or blockchain?
We have Seven Ridge Capital Partners as the owner now of AFX, and they, through their investments in digital asset holding, have a great business in managing tokenization and other digital product offerings analogous to what we're doing currently in just simple trading of cash funds. The Canton Network, which is now run by Yuval, who is an incredible individual, a great portfolio CEO, and you read a lot about what Canton has been up to and doing across blockchains, would allow certain member banks who decide to try with us and alongside of us, if they are trying to manage collateral more efficiently and they've been able to tokenize that collateral, if we're dealing with any of the large fund companies, if we're dealing, hopefully one day with home loan banks who are managing advances to their member banks downstream, all of this I'd like to think could be accomplished in one shape or another on AFX, given that we are a family and partner business inside of Seven Ridge, and we could tap on Yuval and the digital asset group with great regularity and at a moment's notice.
What is the growth of community banks joining AFX?
AFX's client base, ranges from banks at $1 billion up to about $200 billion in assets, and our sweet spot seems to be between 25 and 50. Right, that seems to be where the bulk of our trading and volumes take place. So the onboarding for AFX, as you would expect with any bank, it's not even though we could enact the process quickly, now that we are managing it in-house, it just takes the banks a lot longer to get through their hoops and their traps internally to be able to, flip the switch and start trading. Very easy to get, test trades done, but then to get this regular behavior change of, instead of picking up a phone or IBing on Bloomberg, logging into a GUI, a web-based GUI, and then posting your levels, hitting send, and then waiting for trades to take place and then confirmations to come back and drop copies to hit. All of that takes time. So we have a robust pipeline. We have a dedicated sales team that canvasses the entire country. We've got members in all 50 states. And we do have a pipeline that, since the election on November the 5th, seems to be, we're receiving more inbounds rather than us reaching out. So our team has been incredibly busy, and people have been talking about, hey, it's time that I dusted off AFX and give it another try. Tell me who and how much you guys are transacting. Tell me what some of the developments have been. And those conversations are taking place with greater frequency in the past month. The BTFB program, which was established after Silicon Valley Signature and then subsequently First Republic went out, was designed to allow community and regional banks to fund their book without a haircut at 100%. That reached a peak of about 165 billion in borrowings the middle of last year, and that will then roll off completely in March of 25. So we are seeing that as the BTFB rates have dropped, and they're dropping because the Fed has been reducing rates, so the rates that they could get in the open market are now below what the BTFB is. They are putting those funds back, and as that goes to zero, the natural demand comes back into the market from our borrowers. And as you know, there's a wall of liquidity behind the fence waiting to meet those needs. And, volumes have been ticking up nicely.